Before we dive in, it is critical to understand that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage lender, or real estate agent, and the information provided in this video does not constitute financial, legal, or real estate advice. The mortgage landscape changes constantly, and what is true today may not be true tomorrow. Always consult with a qualified professional, like a licensed mortgage originator, before making any financial decisions. Your financial situation is unique, and you need personalized advice. The 20% down payment is the biggest lie in American real estate. Let me say that again. The idea that you need 20% down to buy a house is a myth. It's a ghost story told around the campfire by your parents, a convenient fiction pushed by big banks, and a tired talking point from financial gurus who haven't applied for a mortgage in 30 years. And today, we are going to drag that myth into the light and expose the truth about how you can buy a home in the United States with absolutely $0 for a down payment. Think about it. You've been doing the late-night Zillow scroll. We've all been there. You find it, the perfect house. It has the home office you desperately need, the fenced-in yard for the dog. It's in a decent school district. You can already picture where your couch will go. Then you pull up the calculator, your heart sinks, and reality hits you like a ton of bricks. A $400,000 home, which in many parts of the country is now a starter home, supposedly requires an $80,000 down payment. $80,000. For the vast majority of Americans, that isn't just a financial hurdle. It's a concrete wall. It's the difference between building generational wealth and being stuck paying your landlord's mortgage for another decade. But what if that wall was an illusion? What if you could just walk through it? In this video, I'm not just going to tell you that zero-down mortgages exist. I am going to give you the exact roadmap. We are going to break down the primary government-backed zero-down payment home loans available right now. We'll cover who they're for, how they work, their hidden benefits, and the potential pitfalls you absolutely must know about. By the end of this, you won't just be a dreamer scrolling on Zillow. You'll be an educated homebuyer armed with the knowledge to make the American dream a reality, potentially years sooner than you ever thought possible. So where did this 20% myth even come from? It's not a law. It's not a federal mandate. It's a risk management tool for lenders. Decades ago, banks determined that if a borrower put down 20% of their own money, they had significant skin in the game. They were far less likely to default and walk away from the loan because they'd lose their own substantial investment. If you put down less than 20%, the bank sees you as a higher risk. To offset that risk, they force you to pay for something called PMI, or private mortgage insurance. PMI is an insurance policy that protects the lender, not you in case you default. You pay the monthly premium, but they get the payout. It's one of the most frustrating expenses in homeownership. The 20% figure isn't a rule for buying. It's a rule for avoiding PMI. And millions of people mistake avoiding a fee for a mandatory requirement to purchase. They are not the same thing. Understanding that distinction is the key that unlocks everything. Because once you realize the goal is simply to get a lender comfortable with your loan, you can start looking at programs specifically designed to do just that without you needing to save for 10 years. And that brings us to the first and arguably the most powerful zero-down mortgage in existence, the VA loan. This isn't just a loan program. It's a promise. It's a benefit earned through service to our country. Established in 1944 by the GI Bill, the VA loan was designed to help returning World War II veterans purchase homes and reassimilate into civilian life. Today, that promise extends to millions of active duty service members, veterans, and eligible surviving spouses. And its benefits are, frankly, staggering. The headline feature, of course, is 0% down. Not 3.5%, not 5%. 0. On a $400,000 house, that means you don't need to bring $80,000 to the closing table. That alone is life-changing. But the VA loan's second major benefit is almost as powerful. There is no monthly private mortgage insurance. Remember that annoying PMI we just talked about? With a VA loan, it's gone. Poof. Vanished. This can save you hundreds of dollars every single month, which directly lowers your total housing payment and increases your purchasing power. You can afford more house for the same monthly payment compared to someone using a conventional loan with a low down payment. So what's the catch? There's always a catch, right? With the VA loan, it's not so much a catch as it is a fee. It's called the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs to help keep the program running for future generations with no additional burden on taxpayers. The fee is a percentage of the loan amount and it varies. For a first-time user with zero down, it's typically 2.3% of the loan value. Before you panic, here's the crucial part. For most borrowers, this fee can be rolled directly into the total mortgage amount. You don't have to pay it out of pocket. So while it does slightly increase your loan balance and monthly payment, it keeps the upfront cost of buying the home at or near zero. Furthermore, veterans receiving VA disability compensation are often exempt from the funding fee entirely, making the deal even sweeter. Now, who is eligible? This is where it gets specific. Generally, you need to have served 90 consecutive days of active service during wartime, 181 days during peacetime, or more than 6 years of service in the National Guard or Reserves. There are specific criteria for different eras of service, and the best way to know for sure is to get your Certificate of Eligibility, or COE, from the VA. This is the golden ticket that proves to a lender you've earned this benefit. Any good lender who specializes in VA loans can help you get this certificate, often in a matter of minutes. Beyond the service requirement, you still have to financially qualify. The VA doesn't lend the money directly. It guarantees a portion of the loan for a private lender. So you still need a reasonable credit score. Most lenders look for a 620 or higher, and you need to show you have stable and reliable income to make the monthly payments. The VA also has its own appraisal process to ensure the home is safe, sound, and sanitary, which is a protection for both the lender and the veteran buying the property. The VA loan is a testament to how homeownership can be made accessible. It's a targeted, powerful tool that has helped millions of veterans build wealth when they might otherwise have been locked out of the market. But what if you never served in the military? Are you just out of luck, stuck trying to scrape together that mythical 20%? Absolutely not. In fact, the next program we're going to cover is one of the best-kept secrets in real estate, designed specifically for rural and suburban areas, and it might just be available right where you live. It's called the USDA Rural Development Loan. And right now, half of you are probably thinking, wait, USDA? Like the Department of Agriculture? I'm not a farmer. I don't want to live on 100 acres in the middle of nowhere. And that right there is the single biggest, most costly misconception about this program, because the government's definition of rural is probably not what you think it is at all. It's not just about cornfields and cattle. It's about people. It's about building and sustaining communities. Think about it from the government's perspective. What happens when everyone floods into a few major superstar cities? Housing prices skyrocket. Infrastructure gets strained. Traffic becomes a nightmare. Meanwhile, smaller towns and the suburbs just outside those major hubs start to hollow out. Businesses close. Young people leave. The economic heartbeat of those communities begins to fade. The USDA loan program is the government's answer to that problem. It's a strategic tool, a powerful incentive designed to encourage people just like you to buy homes and put down roots in the places that form the backbone of America. They're not just helping you buy a house. They're investing in the stability and growth of thousands of communities across the country. And the way they do it is by offering a deal that is, frankly, almost unbelievable. So what is this incredible deal? It boils down to 3 core benefits that completely change the game for homebuyers. First, and most importantly, is the one we're all here for: zero down payment. 100% financing. Let's put that into perspective. The median home price in the United States is hovering around $400,000. A traditional 20% down payment on that home is $80,000. $80,000. That is a life-altering amount of money. It's a mountain that can take the average person a decade or more to climb. With a USDA loan, that mountain disappears. You can go from renter to homeowner without having to drain your life savings or win the lottery. This single benefit catapults the dream of homeownership from a distant, fuzzy someday into a very real, very achievable right now. The second massive benefit is lower interest rates. Because these loans are backed by the United States government, lenders see them as incredibly safe. The government is essentially co-signing your loan, telling the bank, "Don't worry, we've got your back." This reduced risk for the lender gets passed directly on to you in the form of a lower interest rate, often lower than you could get with a conventional loan, even if you had a 20% down payment. A fraction of a percentage point might not sound like much, but over the 30-year life of a mortgage, it translates into tens of thousands of dollars in savings. It means your monthly payment is lower, giving you more breathing room in your budget every single month. And the third benefit is the real secret weapon, the one most people don't even know to ask about: reduced mortgage insurance. Now, if you've looked into buying a home with less than 20% down, you've heard the dreaded acronym, PMI or private mortgage insurance. It's an extra fee tacked onto your monthly payment that protects the lender, not you, in case you default. On a conventional loan, PMI can be brutal, costing hundreds of dollars every month. FHA loans have something similar, and it's expensive and lasts for the life of the loan in most cases. The USDA loan, however, handles this differently. It has what's called a guarantee fee. There's an upfront fee that can usually be rolled into the loan amount so you don't pay it out of pocket, and a much lower annual fee paid monthly. We're talking about a fee that is often less than half of what you'd pay for FHA mortgage insurance. This is a huge, direct savings that lowers your monthly payment even further. When you combine zero down, a lower interest rate, and lower mortgage insurance, the financial advantage becomes undeniable. You're getting into a home with less cash, and your monthly housing cost is significantly lower. Okay, so this all sounds incredible. Too good to be true even. So what's the catch? There has to be a catch, right? Well, it's not a catch so much as it is a set of rules. The program isn't for everyone or for every house. There are two main eligibility requirements you have to meet. One for the property and one for you. Let's talk about the property first. It has to be in a USDA eligible area. And this is where we demolish that myth about living in the middle of nowhere. The USDA's eligibility map is a sea of green. It covers 97% of the landmass of the United States. We're talking about small towns, we're talking about suburbs, we're talking about communities just a 30 or 40-minute drive from major city centers. You would be absolutely shocked to see how many desirable, convenient, and beautiful places qualify. There's a link to the official USDA eligibility map in the description below, and I urge you, pause this video right now and go look. Type in the address of a town you'd like to live in. You might discover that your dream neighborhood is in a USDA eligible zone. The property itself just has to be a modest, single-family home in decent condition. No fixer-uppers, no income-producing farms. Just a normal primary residence. The second requirement is about you, the borrower. This program is designed for low to moderate income households. But just like their definition of rural, their definition of moderate income is probably higher than you think. The income limits are not set nationally. They vary by county and are based on the area's median income and family size. In many suburban counties with a higher cost of living, the income limit for a family of 4 can easily exceed $100,000 a year. The program isn't for the wealthy, but it's designed to help the exact people who form the backbone of our economy. Teachers, firefighters, nurses, technicians, and young families just starting out. You also need a decent credit history. While the USDA itself doesn't set a minimum credit score, most lenders participating in the program will look for a score of 640 or higher. This is still far more accessible than the stringent requirements for many conventional loans. Imagine a young couple. Let's call them Mike and Jessica. He's a mechanic, she's a dental hygienist. They've been diligently saving for years, but every time they get close to a down payment, life happens. A car repair, a medical bill, rising rent. The goalpost for that 20% down just keeps moving further away. They feel stuck, watching home prices climb while they're stuck paying their landlord's mortgage. Then they hear about the USDA loan. They check the map and find out the charming town just 25 minutes outside the city where they work is fully eligible. They check the income limits for that county and discover their combined income falls comfortably within the range. They have good credit from paying their bills on time. Suddenly, the impossible becomes possible. They find a home they love, they get approved for a USDA loan with zero down, and a few weeks later they're holding the keys to their very own house. Their monthly mortgage payment, thanks to the great interest rate and low guarantee fee, is actually less than what they were paying in rent. That's not a fairy tale. That is the reality for tens of thousands of Americans every single year because of this program. So, is it the perfect loan? For the right person and the right property, it is astonishingly close. The trade-off is a bit more paperwork and a slightly longer closing process than a conventional loan, as it has to go through both the lender's and the USDA's approval. But is a little extra patience worth saving $80,000 on a down payment and thousands more over the life of the loan? For most people, the answer is a resounding yes. The USDA loan is a powerful testament to the idea that homeownership shouldn't be a privilege reserved only for those with generational wealth or six-figure salaries. It's a key that can unlock the door to the American dream for millions living and working outside our biggest cities. But what if you don't fit the income or location profile for a USDA loan? What if you've served our country and earned a benefit that is, without exaggeration, the single greatest home buying tool in American history? For those who have worn the uniform, there is a program with no down payment, no income limits, and no monthly mortgage insurance ever. And that's what we're diving into next. It's called the VA Home Loan Guarantee Program. And its story doesn't begin in a bank or a mortgage broker's office. It begins in 1944. With the world at war, President Franklin D. Roosevelt signed into law one of the most transformative pieces of legislation in American history, the Servicemen's Readjustment Act. We know it today as the GI Bill. It was a promise that when our service members returned home from the battlefields of Europe and the Pacific, their country would have their back. It offered education, job training, and one other revolutionary benefit: a pathway to homeownership that bypassed the traditional barriers that kept so many working-class families from ever owning a piece of America. That promise is alive and well today, stronger than ever. The VA loan isn't a handout. It's not a direct loan from the government. It's a guarantee. The Department of Veterans Affairs essentially co-signs on the loan for the lender, telling them, "This veteran is good for it. We've got your back." This simple act of insurance by the U.S. government completely upends the traditional mortgage process and unlocks a series of benefits so powerful, they almost sound too good to be true. So let's break them down. The first and most famous is the one we're all here for: zero down payment. 100% financing. Let that sink in. The single biggest hurdle for most first-time homebuyers is saving up the down payment. For a conventional loan, you're often told you need 20% down to avoid extra costs. On a $400,000 home, that's $80,000 in cash. Even with programs that allow for less, like 3 or 5%, you're still talking $12,000 to $20,000. For an FHA loan, it's a minimum of 3.5%, which is $14,000 on that same house. For millions of Americans, especially young service members and veterans starting their careers or families, that kind of cash is a mountain too high to climb. It can take years, even decades, to save. The VA loan bulldozes that mountain flat. For a qualified veteran on that same $400,000 home, the required down payment is $0. Nothing. You can buy a home with no money down, up to the conforming loan limits in your area, and in many cases even beyond that. This isn't a temporary special offer or a gimmick. It is the foundational principle of the program. It puts the keys to a home within reach, sometimes years faster than any other path. But the zero down payment is just the opening act. The second major benefit is arguably just as powerful, if not more so, over the life of the loan. No monthly private mortgage insurance, or PMI. What is PMI? It's an insurance policy that you, the borrower, are forced to pay for, but it doesn't protect you. It protects the lender. On conventional loans, if you put down less than 20%, the lender sees you as a higher risk. So they tack on a PMI payment to your monthly mortgage bill. This can add hundreds of dollars every single month. On an FHA loan, you pay a similar thing called a mortgage insurance premium, or MIP, and in most cases you pay it for the entire life of the loan. It never goes away. Imagine your mortgage payment is $2,000 a month. With PMI, another $300 gets tacked on. That's $300 that does nothing to pay down your principal. It doesn't build you any equity. It's just gone. Thrown into the fire every month to protect the bank. Over 5 years, that's $18,000. Poof. The VA loan says no. Never. Because the VA is already guaranteeing the loan, the lender doesn't need that extra insurance. So, there is no monthly mortgage insurance ever. It doesn't matter if you put 0 down or 10% down. This benefit alone can save you tens of thousands, even over $100,000 over the life of your loan. It means your monthly payment is lower, and more of every single payment you make goes directly toward owning your home free and clear. Now you might be thinking, okay, 0 down, no PMI. What's the catch? And that is the right question to ask. There is no such thing as a free lunch. The VA loan does have a cost associated with it, and it's called the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs to help keep the program running for future generations of service members, requiring no burden on taxpayers. For most first-time users with 0 down, this fee is 2.3% of the loan amount. So on our $400,000 loan, that's $9,200. But here's the critical part. You almost never pay this out of pocket. It's typically rolled right into the total loan balance. So instead of borrowing $400,000, you'd be borrowing $409,200. Your monthly payment will be slightly higher to account for it, but you don't need to show up to closing with a check for $9,000. And here's where the story gets even better. This fee is not for everyone. Over 1/3 of veterans who use the VA loan pay no funding fee at all. Who is exempt? Any veteran receiving VA compensation for a service-connected disability. Any veteran who would be entitled to receive disability compensation, but is receiving retirement or active duty pay instead. And surviving spouses of veterans who died in service or from a service-connected disability. For these heroes, the funding fee is completely waived, making the VA loan an even more incredible benefit. So we have zero down, no PMI, and a manageable funding fee. What else? How about some of the most competitive interest rates on the market? Because lenders know the loan is backed by the US government, the risk of default is significantly lower. Less risk for them means a lower interest rate for you. It's not uncommon for VA loan rates to be a quarter, a half, or even a full percentage point lower than conventional loans. Over 30 years, that tiny difference in the rate can save you an astronomical amount of money. But who exactly gets to use this incredible tool? Eligibility is the key. It's not for everyone, it is an earned benefit. Generally, you're likely eligible if you fall into one of these categories. First, active duty service members who have served for at least 90 consecutive days. Second, veterans who meet certain service requirements. This usually means 2 years for those who served post-Vietnam, or 90 days during wartime or 181 days during peacetime. Third, members of the National Guard and Reserves with 6 years of honorable service. And fourth, certain surviving spouses of service members who died in the line of duty or as a result of a service-related disability. To prove you're eligible, you need a document called a Certificate of Eligibility, or a COE. Don't let this sound intimidating. Your lender can typically pull this for you online in a matter of minutes. It's a simple, straightforward step that unlocks this entire world of benefits. Now, despite all this, there are persistent myths that can scare people away. Myths like, sellers won't accept offers from buyers with the VA loan, or VA appraisals are slow and overly strict. For years, there was a kernel of truth to this, but today it's largely false. The process has been streamlined. VA appraisals are just as fast as conventional ones, and their goal is simply to ensure the veteran is buying a home that is safe, sound, and sanitary. They're not trying to kill the deal, they're trying to protect you. Another huge myth? That you can only use your VA loan benefit once. This is completely 100% wrong. You can use your VA loan again and again. You can even have more than one VA loan at a time. This benefit is a lifetime key, not a one-time ticket. It's a tool you can use to build wealth for your family throughout your life. Zero down, no monthly mortgage insurance, competitive rates, limited closing costs, reusable for life. It's not a magic trick. It's a promise codified in law and delivered to millions of those who have served. But what we've covered are just the headliners, the big, well-known benefits. What about the hidden advantages? The little-known rules and advanced strategies that can turn this powerful home-buying tool into a generational wealth-building machine? That's where we're going next. So let's talk about the secret weapons. The first one is a single word, and it's a word that can be worth tens or even hundreds of thousands of dollars to you over the life of your homeownership. That word is assumable. What does it mean for a mortgage to be assumable? It means that when you decide to sell your home, the buyer doesn't necessarily have to go out and get a brand new mortgage at whatever the current sky-high interest rate is. Instead, they can, if they qualify, take over your mortgage. They literally assume your existing loan, along with its original interest rate and terms. Now you might be thinking, okay, that sounds neat, but why is it a secret weapon? Let's paint a picture. Imagine two neighbors, Sarah and Mike. Both bought identical houses in 2021 for $400,000. Sarah, a veteran, used a zero-down VA loan and locked in a 2.75% interest rate. Her monthly principal and interest payment is about $1,630. Mike used a conventional loan, put 5% down, and got a great rate at the time of 3.25%. His payment is about $1,650. They're in very similar situations. Fast forward a few years. It's today. Interest rates are hovering around 7%. Both Sarah and Mike get amazing job offers in a different state, and they both need to sell their homes. They put their identical houses on the market for $500,000. This is where their paths diverge dramatically. Mike's real estate agent tells him the market is tough. Buyers are spooked by the 7% interest rates. A new buyer for Mike's house would be looking at a mortgage payment of over $3,100 a month for the exact same house he's paying $1,654. It's a tough pill to swallow. His house sits on the market. Offers are low. Buyers are asking for concessions. He's trapped in what people call golden handcuffs. He has a great rate, but he can't move without giving it up. Now let's look at Sarah. Her agent puts a single magical phrase in the property description. Assumable VA loan at 2.75%. Suddenly, her house isn't just a house anymore. It's a time machine. It's a financial instrument. It's a golden ticket. A buyer looking at her house doesn't see a $3,000 a month payment. They see a $1,600 a month payment. The difference is almost $1,500 a month. That's $18,000 a year. Over the life of the loan, it's a savings of over $500,000. Who do you think gets more phone calls? Whose house has a line out the door for the open house? Sarah's. Buyers are falling over themselves to get that 2.75% rate. And here's the kicker, the part most people don't know. The person assuming the VA loan does not have to be a veteran. That's right. A regular, non-military buyer can take over a veteran's loan. This gives Sarah incredible power. She can sell her house faster than anyone else in the neighborhood. She can command a higher price because the value isn't just in the bricks and mortar. It's in the financing attached to it. The buyer will need to come up with the cash to cover the difference between the sale price and what Sarah still owes on the loan. That's her equity. But for a deal this good, qualified buyers will find a way. Mike is stuck. Sarah has a bidding war. That is the power of an assumable mortgage. And guess which zero-down loans are almost always assumable? VA loans and USDA loans. Most conventional loans? Not a chance. This isn't just a small perk. In a rising interest rate environment, it is arguably one of the most valuable features a mortgage can have. It turns your home from a liability that traps you into a flexible asset with a built-in marketing advantage. But that's just one hidden advantage. Let's dig into another one. A myth that keeps thousands of veterans from building real wealth. Most people, even veterans themselves, believe the VA loan is a one-time deal. You use it once and that's it. You've shot your shot. This is completely 100% false. The VA doesn't give you a loan. It provides a guarantee to your lender, called an entitlement. Think of it as a voucher of trust from the government. When you buy your first home, you use up that entitlement. But what happens when you sell that home and pay off the loan? Your entitlement is fully restored. You can go right back out the very next day and buy another home with $0 down. There is no limit to how many times you can do this. You can buy a home, live in it, sell it, and repeat the process over and over again your entire life, using a zero-down loan every single time. It's a benefit you earn for life, not a one-time coupon. But this is where it gets really interesting. This is where we move from just buying a house to building an empire. What if you don't sell that first house? What if you get orders to move to a new duty station, or you get a new job in a different city, and you decide to keep that first house and rent it out? Most people would assume that since you still have a VA loan on that first property, you can't get another one. Your entitlement is all tied up, right? Wrong. This is where we get into a concept called bonus entitlement, or remaining entitlement. And I'll be honest, this is the strategy that separates amateur home buyers from savvy real estate investors. The VA guarantees a certain percentage of your loan, up to the conforming loan limit for the area, which in most of the country is over $766,000. When you bought your first house for, say, $300,000, you only used up a portion of your total entitlement. You still have a big chunk of that government guarantee left over. This means you can keep that first house, turn it into a cash-flowing rental property that someone else is paying the mortgage on, move to your new city, and use your remaining entitlement to buy a second house, also with $0 down. Let that sink in. You now own two properties. One is your primary residence. The other is an investment property that is building equity and potentially putting cash in your pocket every month. And your total cash out of pocket to acquire $800,000 or more in real estate? Zero. Nothing. This isn't some theoretical loophole. This is how the program was designed to be used. It's a wealth-building engine hiding in plain sight. You can continue this. As your income grows and you pay down your loans, you can potentially acquire a third property or a fourth. You can build a multi-million-dollar real estate portfolio that will fund your retirement, your kids' college, and create generational wealth, all starting with that first zero-down loan. Most people think of a mortgage as a debt. They see it as a 30-year burden. But with these programs, if you understand the hidden rules, it becomes the single most powerful tool you have to change your family's financial future. You're not just buying a place to live. You are acquiring an asset that can generate more assets. We've talked about the power of assumability in a volatile market. We've uncovered the myth of the one-time use VA loan and revealed how you can use it to buy multiple properties with no money down. These aren't just small tips. They are fundamental shifts in how you should view these loans. They are the keys to unlocking a level of financial freedom that most people who go the conventional 20% down route can only dream of. But of course, with great power comes great complexity. How do you actually calculate your remaining entitlement? How does the funding fee change on a subsequent use of the VA loan? And what about the USDA loan? Does it have a similar multi-use feature? And what are the specific occupancy rules you absolutely must follow to do this legally and ethically? These details are critical, because making a mistake here can be costly, but getting it right can change everything. And that's exactly what we're going to break down next. The first pillar of this strategy, the one that tackles the down payment itself, is called down payment assistance or DPA. And right away, we need to clear up a huge misconception. DPA is not some secret government handout for everyone. It's a broad term for hundreds, even thousands of hyperlocal programs, each with its own rules, its own funding, and its own purpose. They are almost always run by state, county, or city housing finance agencies, designed to help specific types of buyers, often first-time buyers, or those with incomes below the area median, get a foothold in the housing market. Think of DPA as coming in three main flavors. The first and the rarest is the grant. This is the unicorn. It's money given to you for your down payment that you never have to pay back. It is quite literally a gift. As you can imagine, these programs are incredibly competitive, often have strict income caps, and the funding can run out fast. If you can find and qualify for a grant, you've hit the jackpot. But for most people, the path to zero down lies in the other two flavors. The second and most common type of DPA is a forgivable loan. This is often called a silent second mortgage. Here's how it works. Let's say you need $15,000 for your down payment. A DPA program might give you that $15,000 as a second loan on your property, right behind your main mortgage. But here's the magic. It has a forgiveness clause. For example, the loan might be forgiven over 5 years. This means for every single year you live in that house as your primary residence, a portion of that loan, in this case $3,000, is forgiven. It vanishes. After 5 years of living there, the entire $15,000 debt is completely wiped clean. You never made a single payment on it. Now what's the catch? The catch is you have to stay. If you sell the house after, say, 3 years, you would have had $9,000 forgiven, but you'd have to pay back the remaining $6,000 at the closing table from the proceeds of your sale. It's an incentive program designed to encourage community stability. It's not a trap, it's a trade-off. You trade a few years of commitment for tens of thousands of dollars in upfront cash. For most people buying a home they plan to live in, this is an incredible deal. The third flavor is a simple repayable loan. Sometimes this loan is deferred, meaning you don't have to pay anything on it until you sell or refinance the house. At that point, you just pay back the original amount you borrowed, often with zero interest. Other times, it might have a very small monthly payment that's added to your main mortgage payment. While not as amazing as free or forgivable money, it still solves the number one problem: coming up with a huge chunk of cash to close the deal. So how do you find these programs? You don't call your big national bank. You go local. Open Google and search for your state housing finance agency. Then search your county down payment assistance. Then your city down payment assistance. You will be shocked at what you find. These programs are hiding in plain sight. This is your first piece of critical homework. Okay, so DPA handles the down payment. But what about the other mountain of cash you need? The closing costs. This is where the second pillar of the zero down strategy comes in: seller concessions. This is, without a doubt, one of the most misunderstood parts of a real estate transaction. Seller concessions, also known as seller credits, are when the seller agrees to pay for some or all of your closing costs. These costs include things like lender origination fees, appraisal fees, title insurance, attorney fees, and setting up your escrow account for property taxes and homeowners insurance. These can easily add up to 2, 3, even 5% of the purchase price. On a $400,000 home, that's another $8,000 to $20,000 you need to bring to the table. So why on earth would a seller agree to pay your bills? It comes down to simple math and marketing. Imagine a house is listed for $400,000. You, the buyer, need $10,000 for closing costs. You could offer $390,000 and try to pay the closing costs yourself. Or you could offer the full $400,000, but ask the seller for a $10,000 concession at closing. Look at the numbers from the seller's perspective. In both scenarios, what do they walk away with? $390,000. Their net profit is identical, but for you, the buyer, the difference is night and day. In the second scenario, you just kept $10,000 in your pocket. You financed your closing costs into the loan without actually increasing your monthly payment by a meaningful amount. It's a brilliant piece of financial leverage. But here is the absolute, non-negotiable, critical rule you must understand. This is the part where people get into legal trouble. Seller concessions can only be used for legitimate, documented closing costs, prepaid expenses, and something called mortgage discount points, which we'll cover later. They can never, ever be used for your down payment. I want to repeat that. A seller cannot give you money for your down payment. If you write an offer where the seller credit is higher than your actual closing costs, the lender will simply not allow it. The extra money doesn't go into your pocket, it goes back to the seller. Trying to disguise this is mortgage fraud, plain and simple. So, do you see how the two pillars lock together? It's a two-key system. Key number 1, down payment assistance. You find a local DPA program to provide the 3.5% or 5% you need for the down payment. Key number 2, seller concessions. You negotiate with the seller to cover the 2 to 4% you need for closing costs. When you use both keys together, you turn the lock. The vault opens and you can walk into a home with little to no money out of your own pocket. This isn't a theory. This is a playbook. Here's how you execute it. First, you must get pre-approved with a lender who is an expert in your local DPA programs. Not all lenders are approved to work with these agencies. A good loan officer who specializes in this will be your guide. They'll know which programs you qualify for and exactly how much DPA you can get. Second, you structure your offer correctly. Let's go back to that $400,000 house. Your lender and agent calculate your closing costs will be around $12,000, which is 3% of the price. So you offer the seller the full list price of $400,000, but you write into the contract that you are requesting a 3% seller concession. Your real estate agent is crucial here. They need to be able to explain to the seller's agent that this is not a lowball offer. It's a full price offer structured to make the financing work. The seller nets $388,000, which might be exactly what they would have accepted anyway. But this brings us to the catch. And there are always catches. This strategy is powerful, but it's not a cheat code with no consequences. The first reality check is that loans that allow for DPA often come with a slightly higher interest rate. The housing agencies and lenders take on more risk, and they compensate for that with a rate that might be 1/4 or 0.5% higher than a traditional loan with 20% down. This is the trade-off. You get into a home now and start building equity now in exchange for a slightly higher monthly payment. You can always refinance that loan later when you have more equity. The second and potentially bigger risk is the appraisal. If you offer $400,000 with a $12,000 concession, the home must appraise for at least $400,000. The bank will only lend based on the appraised value. If the appraiser comes back and says the house is only worth $390,000, the whole deal is in jeopardy. The seller won't get their price, the lender won't approve the loan, and you're back to square one. This makes the strategy much riskier in a flat or declining market. And finally, your success is completely dependent on your local market conditions. If you're in a bidding war with 10 other buyers, and one of them is offering all cash, your offer with DPA and seller concessions is probably going to the bottom of the pile. It's seen as more complicated and having more potential failure points. This strategy thrives in a balanced market, or a buyer's market, where sellers are more willing to negotiate to get their home sold. So you have the two-pronged strategy: DPA for the down payment and seller credits for the closing costs. You understand the rules, the risks, and the playbook to make it happen. But what kind of loan is this strategy actually built on? Is it an FHA loan? A conventional loan? A VA or USDA loan? Because the specific loan program you choose is the engine that drives this whole vehicle. And the rules for each one are dramatically different. Getting that choice wrong can kill the deal before it even starts. So let's pop the hood on these engines, starting with the most powerful and exclusive one on the lot, the VA loan. This isn't just a loan program, it's an earned benefit. It's a promise made to the men and women who have served in the United States military. If you are a veteran and active duty service member, or an eligible surviving spouse, this is without question the single greatest mortgage product on a planet. It was created after World War II under the GI Bill, with a singular noble purpose: to help returning service members buy a piece of the country they fought to defend, to plant roots, and to build wealth for their families. And it achieves that with 3 incredible features. First, it is a true, honest-to-God, zero down payment loan. There's no asterisk, no fine print. If the home is appraised for the sale price, you can finance 100% of it. Second, and this is the part that saves people thousands upon thousands of dollars, there is no monthly mortgage insurance. On almost any other loan with less than 20% down, you're forced to pay an extra fee every single month, called private mortgage insurance or PMI. It's basically an insurance policy that protects the lender in case you default. With a VA loan, that fee simply doesn't exist. The government's guarantee replaces the need for it. That can easily save you $200, $300, even $400 a month compared to other loans. Over the first few years, that's like getting a free car. Now, there is a one-time fee called the VA funding fee. This fee helps keep the program running for future generations of veterans. For first-time users, it's typically 2.3% of the loan amount, and it can be rolled right into your mortgage so you don't pay it out of pocket. But here's another game changer. If you are a veteran receiving VA disability compensation, that funding fee is completely waived. Zero. Gone. Making the best mortgage in America even better. The VA loan is also famously lenient when it comes to credit. The VA itself doesn't set a minimum credit score, though most lenders will look for something in the low 600s. They're more interested in your recent financial history and your ability to repay than a mistake you might have made years ago. So what's the catch? The catch is its exclusivity. You have to have served. It's a supercar, but only a select few are given the keys. But what if you haven't served? What if your dream is a house with a big backyard, a little further out from the city center? For you, there's the second true zero-down loan, the USDA loan. And we need to clear up a massive misconception right now. When people hear USDA, United States Department of Agriculture, they think of farms, tractors, and endless cornfields. That is not what this loan is for. The USDA Rural Development Loan is designed to encourage growth and homeownership in less dense areas of the country. And you would be shocked at what the government considers rural. We're talking about countless small towns and suburbs, many of which are just a short drive from major metropolitan areas. Think less pitchforks and overalls and more quieter streets and better school districts. Like the VA loan, the USDA loan allows you to finance 100% of the home's value. Zero down payment required. But it operates on a different set of rules. First, there are geographic restrictions. The property itself must be located in an eligible rural area. You can check this in about 10 seconds on the USDA's official eligibility map online. Just type in an address and it tells you yes or no. Second, there are income limits. This program is specifically for low to moderate income households. The limits vary by county and the number of people in your family, but they're often much higher than you'd expect, sometimes exceeding $100,000 a year in certain areas. This loan isn't for the wealthy. It's for the working-class families that form the backbone of these communities. Unlike the VA loan, the USDA loan does have mortgage insurance, but it's generally cheaper than other options. There's a small upfront guarantee fee that gets rolled into the loan, and a small annual fee that's paid monthly. The USDA loan is the all-terrain vehicle of mortgages. It is incredibly capable and can get you where you want to go with no money down, but only if you're traveling on its approved terrain. Okay, so you haven't served in the military, and you want to live in the heart of a bustling city or a dense suburb that doesn't qualify for a USDA loan. Are you out of luck? Not even close. This is where the most common low down payment loan in America enters the picture: the FHA loan. Now let's be crystal clear about something. An FHA loan is not a zero down loan. Its minimum down payment is 3.5%. So why are we even talking about it in a video about zero down mortgages? Because the FHA loan is the undisputed champion of being paired with down payment assistance programs, which we'll cover in detail later. It is the single most common path for people to buy a home with little to no money out of their own pocket. Insured by the Federal Housing Administration, this loan was born out of the Great Depression to get the housing market moving again, and its core mission has never changed: to make homeownership accessible to as many Americans as possible. And it does that by being incredibly flexible. The credit requirements are the most lenient of any major loan type. Lenders can often approve FHA loans for borrowers with credit scores as low as 580, and sometimes even lower. It's also more forgiving when it comes to your debt-to-income ratio. That's the percentage of your monthly income that goes toward paying debts. The FHA allows for a higher ratio, meaning you can have more existing debt, like car payments or student loans, and still qualify. For millions of Americans, the FHA loan is the only key that will unlock the door to homeownership. But that flexibility comes at a steep price, and its name is Mortgage Insurance Premium, or MIP. This is the FHA's Achilles heel. FHA MIP has two parts. First, there's an upfront premium of 1.75% of the loan amount, which is almost always rolled into your loan balance. Second, and this is the killer, there's an annual premium paid in monthly installments that, for the vast majority of borrowers, lasts for the entire life of the loan. It never goes away unless you sell the house or refinance into a different type of mortgage. That monthly MIP payment adds hundreds of dollars to your mortgage payment forever. It's the trade-off. The FHA is the dependable workhorse. It will get you across the finish line, but it will cost you more in fuel over the long haul. So what if you have pretty good credit, but you just haven't had the chance to save up a big down payment? And the thought of being stuck with the FHA's lifelong mortgage insurance makes your skin crawl? For you, there is an increasingly popular and powerful option: the modern conventional loan. For decades, the myth was that you needed 20% down to get a conventional loan, the kind backed by Fannie Mae and Freddie Mac. That is completely false. Today, you can get a conventional loan with as little as 3% down. Programs like Fannie Mae's Home Ready or Freddie Mac's Home Possible are specifically designed for this. Like the FHA loan, this 3% down payment is often covered by a down payment assistance program, allowing a buyer to get in with next to nothing. But the conventional loan has one monumental advantage over the FHA loan. Its mortgage insurance, called PMI, is cancelable. Once your loan balance drops to about 80% of your home's value, you can call your lender and request to have the PMI removed. It also automatically terminates by law once your balance hits 78%. This is a massive deal. It means that after a few years of paying your mortgage and home appreciation, you can shed that extra few $100s a month from your payment, while the FHA borrower is stuck with it forever. The catch? It's harder to qualify. Conventional loans demand higher credit scores. You'll typically need at least a 640, but the best terms go to those with 720 or higher. They also have stricter guidelines for your debt-to-income ratio. The lenders aren't getting that extra layer of FHA insurance, so they are pickier about who they lend to. This is the sleek sedan of the mortgage world. It offers superior long-term performance and efficiency, but you need to be a more qualified driver to get the keys. So you've picked your engine: the VA, the supercar for veterans; the USDA, the all-terrain vehicle for rural and suburban areas; the FHA, the workhorse for maximum flexibility; or the conventional loan, the efficient sedan for those with good credit. But even with a loan that requires 0 or 3% down, you're not walking into a house for free. There's a hidden cost that trips up almost every single first-time buyer: closing costs. And this is where the real magic and the real danger of these programs comes into play. How do you cover thousands of dollars in fees when your bank account is already empty? That's the billion-dollar question we need to answer next. There are three main paths to solving this closing cost puzzle, and each one comes with a serious trade-off. Think of it like a deal with a genie. You can get your wish of paying nothing up front, but you always pay a price somewhere else. The first and most common path is called a seller concession. The name sounds friendly, right? The seller is conceding something to you. In practice, it means you negotiate for the seller to pay a portion, or even all, of your closing costs. You might be thinking, why on earth would a seller agree to pay thousands of dollars of my fees? It's simple: to make the deal happen. In a competitive market, or if a seller is highly motivated to move, they might agree to this to lock in a buyer who might otherwise walk away. Here's how it works in the real world. Let's say you find a house listed for $300,000. Your closing costs are estimated to be about $9,000, or 3%. You don't have that $9,000. So, you make an offer, but not for $300,000. You offer $309,000, and you add a clause asking for a $9,000 seller concession to be applied to your closing costs. Let's trace the money. At the closing table, the house is officially sold for $309,000. The seller gets that money, but immediately gives $9,000 back to cover your fees. In the end, the seller still walks away with their target price of $300,000. And you? You walk into your new home having paid nothing out of pocket. Feels like magic. But it's not magic. You didn't get $9,000 for free. You borrowed it. Your loan isn't for $300,000. It's for $309,000. You are now paying interest on your closing costs for the next 30 years. That extra $9,000 at a 6.5% interest rate over 3 decades will cost you an additional $10,700 in interest alone. You've turned a $9,000 problem today into a nearly $20,000 problem spread out over the life of your loan. Furthermore, there are limits. Lenders won't let you infinitely inflate the price of a home just to cover costs. They cap seller concessions, usually between 3 and 6% of the purchase price, depending on the loan type and down payment. Why? Because they need the final price to be supported by the appraisal. If you offer $350,000 for a $300,000 house just to cover costs, and the appraiser says it's only worth $300,000, the whole deal falls apart. The seller concession strategy only works if the house has enough wiggle room in its value to absorb the extra cost. So that's path number 1, you get the seller to pay, but you pay them back with interest by taking out a bigger loan. Path number 2 is the lender credit. This is even more direct. The lender, the bank giving you the mortgage, simply says, "Don't worry about the closing costs. We'll give you a credit to cover them." Again, this sounds incredibly generous. The bank is just giving you thousands of dollars? You already know there's a catch. And it's a big one. There is no such thing as a free lunch, especially in banking. In exchange for this credit, the lender gives you a higher interest rate. It might not seem like much. They might offer you a choice. You can have a 6.5% interest rate and pay your own closing costs, or you can have a 7% interest rate and we'll give you a $5,000 credit. Many people, staring at that $5,000 bill, immediately take the higher rate. They solve their immediate, very painful problem of not having $5,000. But they've just made a deal that will cost them dearly for years, potentially decades. That extra 0.5% on a $300,000 loan doesn't sound like a lot, but it adds up to about $90 extra on your mortgage payment every single month. Over the 30-year life of the loan, that free $5,000 credit will cost you over $32,000 in extra interest payments. You read that right. You traded a $5,000 problem for a $32,000 consequence. It is, by far, one of the most expensive ways to borrow money on the planet. The lender is more than happy to make this trade. They're investing in a guaranteed, higher margin return from you for the next 360 months. They're playing the long game. The question is, are you? The third path is a bit more nuanced. Rolling the closing costs directly into the loan. Now, for most conventional and FHA loans, you can't just do this. You can't just say, "My loan is $300,000 at $10,000 for fees, make it $310,000. Doesn't work that way. But with the 2 primary zero-down government loans, the VA and USDA loans, there are special provisions. With a VA loan, the veteran is typically required to pay something called a VA funding fee. This fee can be substantial, often several $1,000s. The VA, however, allows this specific fee to be rolled into the total loan amount. So while it doesn't cover all your closing costs, like title insurance or appraisal fees, it covers one of the biggest chunks, reducing the cash you need at closing. USDA loans have an even more unique feature. In certain situations, if the home appraises for more than the purchase price, the USDA allows you to borrow up to the appraised value. So if you agree to buy a house for $200,000, but the appraiser says it's actually worth $210,000, you may be able to get a loan for $207,000, giving you $7,000 to cover closing costs. This is rare. It requires you to find a home that is undervalued and for the appraisal to come in just right. It's not something you can bank on, but it is a possibility. Now, here's where it gets truly dangerous. This is the moment where the dream of homeownership can curdle into a financial nightmare. A buyer doesn't have to choose just one of these paths. They can combine them. Imagine a first-time home buyer. They've been approved for a zero-down USDA loan. They find a house for $250,000. Their closing costs are about $8,000. They have no savings. So what do? First, they try the seller concession. They offer $258,000 for the house and ask the seller to pay the $8,000 in closing costs. The seller agrees. Great. Problem solved, right? But wait. There are still some prepaid expenses, like homeowner's insurance for the first year, that the seller concession can't cover. Let's say that's another $2,000. So they go to their lender. The lender says, "No problem. We can give you a $2,000 lender credit to cover that. We'll just have to bump your interest rate from 6.75% to 7.125%. The buyer, so close to the finish line, eager to get the keys, agrees without a second thought. Let's look at what just happened. This person is about to walk into a $250,000 house with a $258,000 mortgage at an inflated interest rate. They are starting their homeownership journey $8,000 underwater, meaning they owe more than the house is even worth. And they are paying a premium for the privilege. They have zero equity. In fact, they have negative equity. If they needed to sell the house the next day for some emergency, they would have to write a check for thousands of dollars to the bank just to get out of the deal. This is the hidden truth of the no money down, no closing costs promise. It is possible. You absolutely can buy a house in America without a single dollar leaving your bank account. But you do it by starting in a financial hole. You are betting everything, absolutely everything, on the hope that your home's value will increase, and increase quickly just so you can get back to zero. It's a massive gamble, taken by people who are often in the most vulnerable financial position. They've been told they can have the American dream for free. But what they've really been sold is the riskiest possible entry into the single largest investment of their lives. And the risks don't end when you get the keys. In fact, that's when the most immediate and potentially devastating risk begins. What happens when you own a house, but you have no money left? It's the most common nightmare scenario for new homeowners, and with a zero-down mortgage, you're starting on the very edge of that cliff. The term for it is house poor. It's a deceptively simple phrase that hides a world of stress and sacrifice. Being house poor means you have the house, the physical structure, the address, but you have no financial flexibility. Every single dollar of your income is already spoken for before it even hits your bank account. The mortgage, the property taxes, the insurance, the utilities, they form an unbreakable wall of expenses. You're living in a 4-bedroom, 2-bath prison of your own making. Let's make this real. Imagine a young couple, we'll call them Mike and Jessica. They're military veterans, and they use their incredible VA loan benefit to buy a beautiful home in a suburb of Austin, Texas, with zero money down. They pay the closing costs, the moving fees, and buy a few pieces of new furniture with the last of their savings. They are ecstatic. They pop the champagne, post the pictures on Instagram with the keys, and for the first time they feel like they've truly made it. They own a piece of the American dream. 3 weeks later, the Texas summer arrives with a vengeance. It's 105 degrees outside, and the air conditioner, a 20-year-old unit the home inspector said was nearing the end of its life, finally gives up. The house becomes an oven. They call an HVAC company. The technician comes out, wipes sweat from his brow, and delivers the verdict. The compressor is shot. The whole system needs to be replaced. The cost? $12,000. Mike and Jessica look at each other in panic. They have maybe $700 in their checking account. Their next paycheck is a week away. What do? They don't have an emergency fund. That was their down payment that they never had to save. They can't just sweat it out. It's a health hazard. They have 2 choices, both of them terrible. Option 1. They put the entire $12,000 on a credit card with a 22% interest rate. Suddenly, their monthly liabilities just exploded. On top of their mortgage, they now have a minimum credit card payment of $400 a month, most of which is just interest. That money has to come from somewhere. It comes from their grocery budget, their gas money, their ability to ever go out to dinner again. The joy of the new house is instantly replaced by the crushing weight of new high-interest debt. Option 2, they take out a personal loan. The interest rate might be a little better, maybe 12%, but it's still another massive monthly payment shackled to their finances for the next 5 years. Every month, for 60 months, they'll be reminded of how their dream home immediately betrayed them. This isn't a far-fetched scenario. It happens every single day. A water heater bursts, flooding the basement. A freak hailstorm requires a new roof. A tree falls in the backyard, and it costs $2,000 to remove. When you put every last penny into just getting into the house, you are financially naked. You have no shield. The first unexpected expense, which is not a matter of if but when, becomes a catastrophic event. But the danger of no down payment loans goes even deeper than just being cash poor. It creates a second, more insidious problem. To understand it, we need to talk about 2 of the most misunderstood letters in real estate. PMI stands for Private Mortgage Insurance. And here is the single most important thing to understand about it. PMI does not protect you. Protects the bank. It is an insurance policy that you are forced to pay for, to insure the lender against the possibility that you will default on your loan. Why? Because from the bank's perspective, a borrower with no down payment is a massive risk. You have no skin in the game. If you lose your job and start missing payments, you have very little to lose by simply walking away from the house. You haven't invested tens of thousands of your own dollars into it. So, to offset this risk, the bank requires you to pay for their insurance policy. PMI is typically required on conventional loans when you put down less than 20%. And it is not cheap. The cost is calculated as a percentage of the total loan amount and can range from 0.5% to over 2% per year. Let's do the math. On a $400,000 loan, a 1% PMI premium is $4,000 a year. That's an extra $333 added to your mortgage payment every single month. $333 that builds you zero equity. It doesn't pay down your principal. It doesn't go towards your interest. It is, for all intents and purposes, money you are setting on fire every month, just for the privilege of not having a down payment. It's the hidden fee for entering the housing market with no cash. For years, you'll be making a payment that's hundreds of dollars higher than your neighbor, who put 20% down on an identical house, and you'll have nothing to show for it. This brings us to the silent killer of the zero-down mortgage: the complete and total lack of equity. Equity is the bedrock of real estate wealth. It's the portion of your home that you actually own. It's calculated simply: the market value of your home minus the amount you owe on your mortgage. When you put 20% down on that $400,000 house, you walk in the door on day one with $80,000 in equity. It's a massive financial cushion. It's a safety net. When you buy that same house with a zero-down mortgage, your equity on day one is not zero. It's actually negative. Why? Because you had to pay closing costs, which can be 2 to 5% of the loan amount. So you bought a $400,000 house, you owe $400,000, but you're already $10,000 to $20,000 in the hole from transaction fees. Your starting equity is negative $20,000. This is a terrifyingly precarious position to be in. It means if the real estate market, which is cyclical and unpredictable, dips by even 3%, you are suddenly severely underwater, or upside down on your mortgage. This means you owe the bank significantly more than your house is worth. If your $400,000 house is now only worth $385,000, but you still owe $400,000, you have negative $15,000 in equity. So what? Who cares, as long as you can make the monthly payment, right? Wrong. Being underwater is a financial trap. Paralyzes you. Let's say you get a fantastic job offer in another state. You have to move. You put your house on the market and the best offer you get is $385,000. To sell it, you would have to bring a check for $15,000, plus realtor commissions, to the closing table just to be free of your own home. You would have to pay a bank thousands of dollars for the privilege of losing your house. Most people in this situation don't have that kind of cash lying around, especially our friends Mike and Jessica, who are already drowning in credit card debt from their new air conditioner. So what happens? You're stuck. You can't sell. You can't move for that better job. You can't refinance your mortgage to a lower interest rate, because no bank will refinance a loan that's worth more than the asset itself. You are chained to that property. The dream has become an anchor, dragging you down, limiting your career, your life choices, and your financial future. This combination of being cash poor and equity poor creates a perfect storm for financial ruin. But what if the market doesn't just dip? What if it stays flat for years? This introduces a hidden cost that almost no one talks about, a silent wealth killer that can set you back a decade. It's called opportunity cost. Opportunity cost is a simple idea with devastating consequences. It's not about the money you spend. It's about the potential gains you miss out on from the next best alternative. When you buy a house with zero down, your entire financial world becomes laser-focused on one single, highly leveraged, illiquid asset. You're not just making mortgage payments, you're sacrificing the ability to do anything else with that money. You're giving up the opportunity for that cash to grow, to work for you, to build real, flexible wealth. Let's make this real. Let's imagine two people, both in their late 20s, both earning the same decent salary. We'll call them Mark and Sarah. They both want to buy a home. They're looking at similar starter homes in the same neighborhood, priced at $400,000. Mark is impatient. He's been told his whole life that renting is throwing money away. He sees a zero-down loan program and jumps at it. He gets the keys to his $400,000 house, signs a mountain of paperwork, and feels like he's won. He's a homeowner. He's living the American dream. His monthly payment, including principal, a high interest rate, property taxes, insurance, and that nasty private mortgage insurance, comes out to about $3,500 a month. He's house poor, but he tells himself it's worth it. He's building equity. Sarah's more cautious. She hears the same advice, that renting is a waste, but she decides to run the numbers. She sees the high interest rate and the PMI on the zero-down offer and realizes how little of her payment would actually go toward the principal in the early years. So she makes a different choice. She decides to keep renting her decent, but not glamorous apartment for just 2 more years. Her rent is $2,200 a month. She commits to saving and investing the difference. Now let's fast forward 5 years. The housing market, which everyone assumed would keep screaming upwards, has done nothing. It's been completely flat. Not a crash, just stagnation. This is the scenario nobody plans for. Let's check in on Mark. For 5 years, he's been diligently paying $3,500 a month. That's 60 payments, a grand total of $210,000 out of his pocket. He pulls up his mortgage statement, excited to see how much equity he's built. The number is shocking. His loan balance has only decreased by about $25,000. Where did the other $185,000 go? It vanished. Evaporated into interest payments, property taxes, homeowner's insurance, and nearly $30,000 in PMI alone. Worse, he had to replace the water heater for $2,000 and fix a leaky roof for $5,000. So, after spending over $217,000 on this house, he has a measly $25,000 in equity. But here's the killer. If he tried to sell the house for the same $400,000 he paid for it, realtor commissions and closing costs would be about $24,000. His net proceeds? $1,000. 5 years of work, over $200,000 in payments, and all he has to show for it is $1,000. He is, for all practical purposes, trapped. He can't sell without losing money. He can't afford to move for a better job. He has no equity to borrow against for an emergency. His American dream has become a financial prison. He's running on a treadmill, sweating every month just to stay in the exact same place. Now let's look at Sarah. For those first 2 years, she lived in her apartment. The difference between her rent and Mark's mortgage payment was $1,300 a month. She didn't just let that cash sit in a checking account. She set up an automatic transfer. Every month, $1,300 went straight into a low-cost S&P 500 index fund. After 2 years, she had invested $31,200. Thanks to market growth and compound interest, that initial investment is now worth about $36,000. But she didn't stop there. She got a small raise and decided to keep up the habit. For the next 3 years, while Mark was shackled to his massive mortgage, she kept investing. Let's be conservative and say she just kept investing that same $1,300 a month. Over the full 5 years, she has invested a total of $78,000. What is that $78,000 worth now, after 5 years in the stock market? Assuming a very average 8% annual return, her investment portfolio is now worth over $95,000. Let's pause and compare. After 5 years, Mark, the homeowner, has a net position of $1,000 from his house. Sarah, the renter, has a net worth of $95,000 in liquid assets. That's the opportunity cost. It's not just a few bucks. It's a $94,000 gap in wealth. But the story gets even better for Sarah and worse for Mark. Now, at the end of year 5, Sarah decides she's ready to buy. That same $400,000 house is still on the market. But she's not coming to the table empty-handed. She has over $95,000. She can put $80,000 down, a full 20%. What does this do for her? First, she completely avoids PMI. That's hundreds of dollars a month she will never have to pay. Second, with a 20% down payment, she's a much lower-risk borrower. The bank offers her a significantly lower interest rate than Mark got. Her mortgage on the same priced house isn't $3,500. It's closer to $2,400. She buys the house, and her monthly payment is now only $200 more than her old rent. It's comfortable. It's manageable. And from day one, a much larger portion of her payment is going directly toward principal, building real equity. She still has $15,000 left over from her investments to serve as a healthy emergency fund for any unexpected repairs. Mark is still stuck. He's 5 years into a 30-year loan, paying a higher interest rate, paying PMI with no savings and no way out. Sarah is just starting her journey as a homeowner. But she's starting from a position of immense power. She has $80,000 of equity on day one. She has a lower payment. She has an emergency fund. She has freedom. The opportunity cost wasn't just the $94,000 in missed investment gains. It was the cost of freedom, the cost of options. Mark traded all of his future financial flexibility for the immediate gratification of holding a set of keys. He locked himself into a worst-case scenario, hoping for a best-case outcome. Sarah chose patience and discipline, and in doing so, she created her own best-case scenario. This isn't a fantasy. This is the mathematical reality that gets ignored in the rush to buy a home. The zero-down loan sells you a dream but hides the bill. And that bill isn't just paid with money. It's paid with years of your life spent trapped, with opportunities you can never get back. It's the difference between a home being a foundation for your wealth or a tombstone for your financial future. So we've seen the traps, the hidden fees, the nightmare of negative equity, and the staggering opportunity cost. Paints a bleak picture. It makes you wonder if there's ever a situation where one of these loans could possibly make sense. Is it always a trap? Or are there specific strategic exceptions to the rule? And more importantly, if not a zero-down loan, what are the other smarter ways to get into a home without having a massive 20% down payment sitting in the bank? Because for most people, that's the real challenge. The answers to those questions might just change the way you think about buying a home forever. So let's talk about the real toolkit. The strategies that thousands of Americans are using every single day to bypass the 20% down payment myth and get into a home, often for far less than they ever thought possible. First up, the workhorse of the American housing market, the FHA loan. This isn't a zero-down loan, but it's the next best thing, and for many people, it's a much better starting point. Backed by the Federal Housing Administration, an FHA loan allows you to buy a home with as little as 3.5% down. Let me say that again. 3.5%. On a $400,000 home, that's $14,000, not $80,000. Now, is that zero? No. But is it a dramatically more achievable goal for the average person? Absolutely. FHA loans are designed to open the doors of homeownership to more people, so they're also more forgiving on credit scores. While a conventional loan might want to see a credit score north of 680 or even 700, you can often qualify for an FHA loan with a score significantly lower than that. It's the people's loan. Now there's a catch. There's always a catch, right? With an FHA loan, you have to pay something called mortgage insurance premium, or MIP. This is an insurance policy that protects the lender in case you default, and unlike other types of mortgage insurance, FHA MIP typically stays for the entire life of the loan unless you put down 10% or more, in which case it lasts for 11 years. This extra monthly cost is the trade-off for that low down payment and flexible credit requirement. But here's the pro move. Nobody says you have to keep that FHA loan forever. Many people use an FHA loan to get their foot in the door. They buy the house, they live in it for a few years, they build up equity as the home appreciates, and they pay down the principal. Then, once they have 20% equity, they refinance into a conventional loan and poof. The MIP is gone forever. It's not a life sentence. It's an entry strategy. But what if you have a great credit score, you just don't have a lot of cash saved up? Then you look at what's called a conventional 97 loan. The name says it all. It's a conventional loan, meaning it's not backed by the government, and it allows you to finance up to 97% of the home's value. That means you only need 3% down. 3%. On that same $400,000 home, you're now looking at just $12,000 down. For people with strong credit and stable income, this is often a better deal than an FHA loan. Why? Because of the mortgage insurance. With a conventional loan, it's not called MIP. It's called private mortgage insurance, or PMI. And here is the beautiful, crucial difference. Once you reach 20% equity in your home, you can request to have that PMI removed. It doesn't stick around for the life of the loan. It automatically terminates once you reach 22% equity. This means your monthly payment will actually go down over time. So you get the benefit of a tiny down payment upfront, without the long-term cost of FHA's mortgage insurance. It's the best of both worlds for those who qualify. Now, you might be thinking, okay, 3% or 3.5% is way better than 20%, but $12,000 or $14,000 is still a lot of money. And you're right. So how do we get that number even closer to zero? This is the secret weapon that most people have never even heard of: down payment assistance programs, or DPAs. These are not some national one-size-fits-all program. These are thousands of individual programs run by state, county, and even city governments, all designed to do one thing: help you cover your down payment and closing costs. These programs come in a few different flavors. Some are outright grants. That's free money. Money you never have to pay back. They'll give you, say, $10,000 towards your home purchase just for being a qualified buyer in their area. Others are silent second mortgages. This is a second, smaller loan that covers your down payment. It's called silent because you often don't have to make any payments on it. Sometimes the loan is completely forgiven after you've lived in the home for a certain number of years, like 5 or 10. So you get the money for your down payment, and as long as you stay in the house, that debt literally vanishes. By stacking one of these DPA programs on top of a low down payment loan, you can create a true zero down or near zero down scenario. Imagine this. You get approved for a 3.5% down FHA loan. Then you discover your state offers a DPA grant that covers 3% of the purchase price. Suddenly, your total out-of-pocket down payment is just 0.5%. On that $400,000 home, you're now talking about coming to the table with just $2,000 for the down payment. This is how it's really done. This is the legitimate, financially sound way people are buying homes with little to no money down. You just have to do the research. Go to Google right now and type in your state or your county, plus the words down payment assistance. You will be shocked at what you find. But there's one more strategy, a more advanced strategy for those who want to not just buy a home, but turn their housing into an investment from day one. It's called house hacking. The concept is simple. Instead of buying a single-family home, you buy a property with multiple units, a duplex, a triplex, or a fourplex. You live in one of the units and you rent out the others. And here's the magic part. You can use a low down payment loan like an FHA loan with its 3.5% down to buy these multi-unit properties as long as you live in one of the units. Lenders will even allow you to use the potential rental income from the other units to help you qualify for the loan in the first place. You could buy a fourplex, live in one unit essentially for free, while your 3 tenants pay down your mortgage, build your equity, and even generate positive cash flow for you every single month. You're not just eliminating a housing payment, you're creating an income stream. This single move can catapult you towards financial freedom faster than almost any other investment. It's a complete paradigm shift from thinking of a home as just a place to live, to thinking of it as the foundation of your wealth. So the truth about zero-down mortgages is that while the true, no-strings-attached versions like VA and USDA loans are fantastic for those who qualify, they aren't the whole story. The real story is that the 20% down payment is a relic. It's a myth that holds people back. The real path to homeownership for most Americans is a combination of smarter loan products and local resources. It's about using an FHA or a 3% conventional loan to get in the game, and then using a down payment assistance program to erase most, if not all, of that initial cash requirement. It's about understanding that your first home doesn't have to be your forever home. It can be a strategic stepping stone. Or it can be an income-producing asset through house hacking that pays you to live there. The biggest barrier to buying a home today isn't the 20% down payment. The biggest barrier is the knowledge gap. It's not knowing that these tools exist. But now you know. You know the strategies that can take you from a lifelong renter to a homeowner, building wealth for yourself and your family. The question is no longer, can I afford to buy a house? The question is now, which one of these powerful strategies am I going to use? Which of these ideas was the biggest eye-opener for you? Was it the concept of refinancing out of an FHA loan to ditch the MIP? Or was it the mind-blowing potential of stacking a DPA grant on top of a 3% down loan? Let me know in the comments below. I read every single one. And if this video gave you even a sliver of hope or a new idea, do me a favor and hit that subscribe button. Because the knowledge you gained today is just the beginning. Thank you for watching.